What's up, everyone? What's going on, Mr. Peruvian Bull? I don't even think I know your name. What's your name?
I usually like to keep my real name, on the DL. I can tell you offline.
For sure. So
Yeah, try to
otherwise,
stay anonymous.
is like PB good? Like
P
for because Peruvian Bull's a mouthful to say each time.
yeah, no, PB, Peruvian, Bull. Like if you just say Bull, that's fine. Yeah, no, all the above are totally fine with me.
Beautiful. Well,
Yeah.
I came across some of your work from actually my community. So just to give you like some super quick background, longtime trader, been doing this my whole adult life. I'm 33 now. And I came across GameStop long time ago based on some of its initial movements, right? Because I'm a derivatives trader.
Mhm.
So things that exhibit volatility, I'm going to be there like, a moth to light because we're looking for volatility. It's how we make money. So I've traded GameStop for a little bit. And then this most recent resurgence, I was trading it again, but this time I already had the YouTube channel started. So then I was like realizing that there's a lot more to this than I originally realized. I didn't understand the story behind it. I didn't understand the different players. I literally was just trading it previously. So, anyways,
Mhm.
long story short, started a series where I was looking closer at GameStop because, from a trader's perspective, it's like a anomaly, right? Like I've been trading my whole life, and it
Yeah.
just moves completely differently than everything else. So I cannot help but be fascinated. Then you throw in a character like the cat, who you look at him and this dude's losing $200 million in a day and he doesn't care at all. Like everything related to like logical trade management's not there. So it's like, it's nuts. So I became infatuated with it. And then my audience, they were like, yo, do you know this dude? Because he looks at some of this stuff too. And I was just like, oh, perfect. I'm looking to talk to everybody I can. I met with Richard
Mhm.
Newton a little bit. He and I did a couple live streams and I text with him about the madness that is GameStop. But that's how I came across you, and I'm absolutely stoked to chat with you about it, man.
Yeah, no, thanks for having me on. I've been involved with the community, since January of 2021. I've been grateful to be here. It has been a wild ride, and that is, what you mentioned right there is the key point that I think most people do not get is that GME is not like the others. It is a complete anomaly in terms of, trying to trade and understand its pricing movements. Like it doesn't follow the normal laws of supply and demand. And that's what has changed people's views on the financial system and made people realize that there's a lot of stuff going on beneath the surface with regards to stock lending, settlement plumbing, options derivatives that doesn't normally occur with other stocks. So yeah, it's an incredible journey. And I think the deeper you go down the GameStop rabbit hole, the deeper you'll realize, how little you understand about the US stock market because this thing is a behemoth and there's a lot of skeletons in the closet.
I think that's one of the what you just said there has been one of my favorite things about this because I have buddies that trade that I'll talk with and be like, dude, like why are you so obsessed with like understanding GameStop? Move on, do something else. And I try to explain to them, I was like, the most interesting thing I find about GameStop in like the ape community, which I continue to reiterate, like I view myself as a guest, right? Because I've traded it for a while, but I don't know anything, half of what long-standing people in the community know, and I respect it. But
Mhm.
one of the most intricate, like intricate details about GameStop is how involved the ape community has gotten with all these small, tiny, nuanced concepts that you can ask the majority of traders, like my friends who've been trading as long as I have, they don't know shit about it. And it's because, like, from
Mhm.
a trading perspective, it doesn't impact us directly. So it's offered me a completely new lens to learn more about this world that I'm obsessed with, which is trading, right? It's what I do. So the first thing I wanted to ask you, though, just so I can gain some more context about your background, is you said obviously you're around 2021. What led you to
Mhm.
GameStop? Was it like the same as most other people, or had you been trading for a while and then pivoted over to that? How did that start?
Sure. No, yeah, I've been trading since 2016 actually. I'm
Okay.
older than I look. I have a baby face. But I
How old are you?
studied
Oh,
I'm
range is
in my
fine.
late 20s. Late 20s, late 20s.
Yeah, I mean, I
Very
don't
late
know.
20s, yeah.
I should have asked the chat how old they thought you were first because I would have guessed mid to late 20s. See, that's the other
Okay.
thing though, is that you have, I'm assuming you're Peruvian, right? So you have some brown in you somewhere. Yeah, because
Yeah,
from
yeah. I'm half Peruvian, but I'm an American citizen.
yeah, well, good. Okay, everybody that's worried about deporting this guy, chill. He's an American citizen. Everybody relax. If ICE
Yeah.
is listening in, calm down. But it's just the fact that, like, as you could tell, I'm as white as they come, and we just aged terribly, right? Because when I told you I was 33, you're probably like, "Yo, this motherfucker looks like he's 45." But yeah, it's like the exact opposite that you have, where you'll look young forever, and I look like I'm dead already. So sick, great for me.
Well, I think you're fine. I think the beard adds some, and I've grown out my beard too before, and it does make you look a little more aged. But yeah, no, if you cut the beard, you'll probably look like me. You'll probably look like a
I look like a
young 29-year
child
old.
with yeah, I look like a child without the beard. It's actually kind of scary. I had my wife knew me when I was on active duty in the Marine Corps, and she literally has told me, like, she's like, this is the only time I've ever saw your face. It's like ever since I went on the reserves and whatnot, I've never seen my face either. So hopefully I won't know what it looks like.
Nice, nice. Actually, a lot of my family's military. My brother was in the Navy,
Beautiful.
so
Very
for a
good.
few
I
years.
love
Yeah,
that. Yeah,
yeah.
that's good. So you
Yeah, no,
got
but
trading since 2016?
yeah. So trading since 2016, but I studied finance and economics, and I went to go work for a fintech company, um, doing basically like valuation style work. And so I also had some internships here and there with like, actually portfolio management, but I actually like out of college, I went into literal just valuations of
Got it.
small to medium sized enterprises. And in 2021, we see this massive rise in the GameStop price. I start following it like the second week, and instantly I'm led to the DD, which is all this older posting from, I'd say no fall of 2020 and even before, discussing why GameStop is a massive value play and why this stock is overshorted.
Hmm.
And as the stock begins to rise, right through early 2021, through this, second and third week of January, I'm working, uh, in an office building with all the other financial analysts and valuations managers and CPAs, and there's a couple guys who do charting, obviously, because we're in finance, so they want to just make money on the side apart from their day job. And I get a lot of them to start looking into this. We actually started a company Slack on GME. So we're all talking about GameStop. And we start noticing like some really weird, movement, price movement. Like, you see the stock rip up into the after hours. And then once it enters after hours, the stock price tanks. We start seeing news media and coverage come out insanely negatively on this is the third week of 2020 of January 2021.
Hmm.
And then you see the large shorts like Citron Research, for example, a bear trap style publisher. Um, he comes out and he's just like, this thing's going to $5. You guys are all retarded. You don't understand short interest. Like this thing's going back to zero. And then the stock keeps rising, right? Past 20 into 30, 40, 50. And on the Friday of, it was the 21st of January, we see the stock price rip up into like 50 and then get slammed down to 30 and then close at 40. And everyone, and it was this kind of sensation of like, okay, this is like a storm coming. Like, what the hell was that? Like, I have never seen a stock rip that much and then collapse in the after hours, then close higher. Like, I've never seen that in my life. And that weekend was kind of quiet, right? And there were some articles coming out. Melvin Capital is underwater. Citadel is looking into rescuing them and funding them. And then the next week, Monday, Tuesday, the stock price just starts to go parabolic and starts to rip through all barriers, right? We're talking goes to from 50 to 80 to 100 to 150 to
Hmm.
200. And this financial media, the financial establishment goes crazy. And as someone who's studied, like again, I studied finance, economics. I'd worked at a large insurance carrier before. I'm familiar with the financial media, right? And I've been studying also. I'll say this too. Prior to this, I'd been studying for about 6 years macroeconomics in depth. Mainly focusing on Triffin's dilemma, reserve currencies, And I'd also been looking at, oil markets. And so I'd been doing a lot of research in that area, but it was separate from, the more, I thought, like arcane or just boring stock market. I was more interested in the macro side. And but as the stock price began to rip and the entire financial media trotted out, I was, curious. I'm like, what's their bone to pick? Like, if this is truly a dying
Right.
company that only a few hedge funds have shorted, why is the entire financial establishment coming against this? And then 2 days later, we got our answer. They shut off the buy button and froze buying for basically, like, I was like 175 retail brokers, basically the entire retail broker ecosystem. And the only places you could actually get orders through were Vanguard and Fidelity. And the reason why was because those large asset managers had their own, they had their own internal inventory of GME
Right.
shares, so they could sell it to you.
Right.
But otherwise, if you tried to go to the open market, you weren't able to buy.
Right. And all right, so a lot there. So first question though, off shooting a little bit. What do you think of oil here now? Oil's starting to pop up a little bit.
Oh yeah, it's in the 70s. Yeah, I think oil broadly is an indicator of economic strength, right?
Mm-hmm.
And it also is an indicator of how, in my opinion, of a political desire to lower inflation. So whenever they drain the SPR and they lower oil prices, lower gas prices, to me it's a political move, and I think that uh, there's no doubt they're doing this before the election to help secure, Democratic vote, because they want to make the incumbent look better. So my
Yeah.
opinion, if I were to guess on oil prices, although I don't follow them as much as I used to, if I were to guess, I'd imagine we're going to remain range bound because they're going to try to increase production, especially domestically in the U.S. until the election.
Yeah, I was surprised that they didn't already announce it, to be honest. As soon as I saw it start rallying into the high 60s, I thought for sure they were going to uncork it. But
Yeah.
we'll see. Maybe they're just a little slow to the punch here. Cool. So going back to GameStop then, when you first started getting involved with it, did you set up your portfolio in a way where you're like still trading, doing your thing, and then had some of it in GameStop? Are you roaring kitty degenerate level, all life savings, go into some, like, just getting a scale of how that looks?
Sure. So I had a large portfolio invested in, or at large, at least, in
Sure.
my view, it wasn't big, less than 50,000 or less than 30,000 total. But yeah, because at that point I'd only just started working because I had trouble getting a job during the pandemic. But I was mostly in actually gold stocks prior to GME, gold miners, and I bought a bunch of leaps on those. And so I liquidated some of those positions. And so by the end of January, I was probably half GME and half gold stocks. But a large part of that was also because of appreciation, right? Because I started buying in at like maybe like 80, and then the price was at like 300, 400. So yeah,
Right.
at a certain point, I think it was like 70% GME. So
Got
I,
it.
I,
Yeah.
I
Just
grew it to a large portion of my portfolio.
Yeah, got it. Interesting. Because that's one of the things I find so interesting about people who trade GameStop in different ways, because my portfolio turnover is exceedingly high, right? I'm trading. So most of my stuff I might hold for like a couple weeks. So that's why I asked that question, is because it's interesting to understand the dynamics of, do we let it grow and consume more and more of the portfolio? Do we cut it down, move it to other things? I also think that that reflects a lot of the conviction, which it sounds like you were still pretty strongly convicted with the direction it was going.
Absolutely, yeah. I mean, like them turning off the buy button was the answer, that was the answer to the question we had. We thought, can this thing blow up the financial system? And the answer was yes. They had to
Yep.
shut off the buy button for a reason, because it literally was doing that. That's what people don't understand with GME, right? Like, there's been other stock squeezes before, but none of them were ever systemically risky, right? Like,
Right.
this was essentially a Lehman moment for the stock market. And so this was difficult for most traders to understand. And then what happens later, right? If you follow the stock price of GameStop, and if you follow the community in those early days, after that week, right? They freeze buying, they restrict buying for the next like week and a half. all this media, FUD comes out. They tell us that retail's dying. They've tapped all their savings. We're all going into silver. It's over. The Reddit crowd is crazy. They shut down the Discord. There's a community Discord for Wall Street Bets. And then they even have talks about suing Reddit for market manipulation, etc. And over the next few weeks of early February of 2021, the stock price just tanks and it goes all the way back down to like, I think it was like $40 at one point. And everyone said, like all the traders who, like day traders who said, like, look, this is just a squeeze. It's over. You guys should have sold at the top. You're all retarded. Now you're all bag holders. Ha ha ha. There's all these memes everywhere, right? And we all thought we're like, fuck, man, maybe that's right. Maybe this squeeze is over, and maybe they were able to escape. Maybe they covered at 300, and this is it. Like it's over. And then late February, it was like February like 23rd or something. The stock price after hours goes from 40 to 100. And then the next day goes from 100 to 140. And we're just like, what the fuck?
We are so back.
Yeah, we're so back. And then over the course of the next month, it goes back up to 300 and it touches 300 multiple times. And every time it touches 300, we see a whipsaw where it gets rocketed down by like $80, especially after earnings. If you go look at the history of GME stock trades after earnings, it's insane. Like the stock price will kind of go lower and then it'll in the week or so before it'll run up usually. And then after earnings, it'll get slammed. And so we saw in March of 2021, I remember watching live, the stock price went to like 305. And then after earnings, it went down to 150. And then it came back up to like 200. So it got like, I mean, again, these are moves you never see in another stock,
So the funny part that you mentioned about the moves that you don't see in other stocks, I back literally way back in like the mid 2010s, I had started buying data from SIBO so that I could test ideas. And this is, a little bit old school compared to what you can do now. But every time that I would test different ideas from like an options trading perspective, understanding how things work in different size companies, whether it works differently in indices, ETFs, stuff like that. And every single time that I would get like these weird returns in the strategies, there was a handful of names that kind of became the usual suspects. And in the beginning, it was minor deviations, yada, yada, yada. And then all of a sudden you come into like the early 2020s, the same fucking name pops up over and over again. It was fucking GameStop was in that cohort of things that just kept breaking all the rules with these different strategies. And I was like, what the fuck is this? So it's funny that you guys picked up on very much of that same anomalous movement. Now, one other question I had for you, and then we can kind of pivot to some of, what the chat wants us to talk about. They have a couple questions about like swaps and stuff like that. But just another general question for my own understanding. One of the things I find so fascinating about the ape community is I find there to be like a broken approach just in terms of methodology. And again, this is like from a pure trading perspective. So a lot of people, they talk about MOAs or like wanting to see like this really big squeeze. I understand that. The part that I don't fully understand is that most of them, when I kind of will talk to them about like how this works, what's the plan, there's no exit plan for a lot of these people, right? They kind of just talk about like up or to the moon. And I don't know if it's like, if I'm looking at it too literally, but from a trading perspective, I just think like I get that we want a big squeeze. I get that. And I love that. But if you hold it all the way through, then you don't make money, right? You still have the same. So then to me, it almost sounds like it's like a value play, right? Because if we're thinking long-term holdings, we're thinking long-term price accumulation, but there's so much focus on the squeeze. I don't get that. So to summarize all of that, why is there the emphasis on the squeeze, but then the traders don't have like an exit strategy during the squeeze? Why is that?
So that's kind of a meme. I mean,
Okay.
it's from the reason why that is because so during that week, right, the last week of January 2021, this is kind of like the watershed moment that anointed most of the original OG GME apes. But there were other watershed moments like March of 2021 or April or a lot of the earnings events, or even like this summer, right? We saw massive swings in the price in May and June of this year.
Yep.
And then, swings in the price of Chewy as well and other related stocks. Um, During that initial week, right, people were coming to Wall Street Bets. The audience size was growing exponentially, right? They got front page of Reddit like dozens of times during that week. Like, they were the most popular subreddit literally for the entire month. And people were referring to DFV and they were saying, look, like he did this stuff in September of 2019. He bought more in 2020 and he's been holding, and he started posting these daily updates where he shows his
Yep.
holdings. And you see like, oh, the stock price closes at 200 one day. He's at like 13 million. Then it falls down to $100 the next day. And then he's at 6 million and he doesn't sell a share.
Yep.
And everyone's like, whoa. And then this, kind of climax, as you could say, in them cutting off the buy button. So after they cut off the buy button, there's a lot of panic selling. A lot of people freak out in the community. They think, oh my God, the squeeze is over. They're not going to let it squeeze. They're not going to let this happen. This FUD and just negativity spread. And DFV tweeted at the close of business day, a close of market, like his update, and he hadn't sold a share. And everyone was just like, holy shit. Like this guy, it's another, it's like another it's a complete wrench in the ideology of most big bank traders, right? Like you're supposed to sell and make money, and
Hmm.
why would he not sell at the top? Like you don't understand. And then there was an older Reddit response for him when people asked him what his exit strategy, and he said, "What is an exit strategy?"
Yeah.
His goal
Yep.
was to hold it forever, and so people coalesced around him, and they said, "Look, he during all this corruption, during all this bullshit, he didn't sell." And there's this rage built up from 2008 that kind of boiled to the surface, and all these posts went viral on Superstonk that day, or on Wall Street Bets, discussing the 2008 financial crisis and how it had affected us. And they said this is one of our chances to get these people. And with them shutting off the buy button, people were furious, and people started
Hmm.
buying GME. We saw people who had no money, who their last $200 they bought some GME, and they said, "I'm doing this not for any like profit reason, but because my brother committed suicide because he lost his home in 2008, or my uncle was an investment banker, lost his job, lost everything, and he went into depression for 10 years." Like there's all these personal stories that started spreading, so people said, we're never selling. Like if they're going to pull the strings and change the rules, we're going to change the rules. So the meme was like, they shut off the buy button, we shut off the sell button, so we won't sell. And so the point of the squeeze,
Interesting.
yeah. So for a lot of people, look, and a lot of people said, I'm not going to paint the community as a monolith because it isn't. This is just a group of people who are interested in the same thing, just like the
Yeah.
Bitcoin community. But I would say this, a lot of people, even with large number of shares, are going to say, we're not selling a large portion of our shares because we want the squeeze to happen and we want to destroy these hedge funds that have overshorted GameStop and overshorted Bed Bath and Beyond and overshorted 50,000 other tickers since, they've discovered this naked shorting loophole and the FTD loophole. And the goal is to bankrupt them, right? To get them out of the market because what they're doing is damaging. I don't know if you've ever heard of seller boxing
Yep.
in trading, but there's documentable evidence from all the large brokers that market makers, hedge funds, and then the banks themselves have been engaging in predatory naked short selling practices. And this has been, by the way, this has been going on for decades. There's a court case in 2005 that was brought before that went all the way up to a Supreme Court that actually forced a lot of public attention on this, and it also forced congressional hearings, which made the SEC implement Reg Show, and they created the threshold list showing like how many days stock has been overshorted, and if it's more than I think it's 1% of the float. Oh no, if it's FTDs. If it was 1% of the float is FTDing for 5 trading days consecutively, you get put on the threshold list. And so all these implementations got put in place in the early to mid 2000s because this was known to be an issue. I mean, there was CMKM Diamonds, there was there's another one. There's an investor by the name of Global Links, Richard Simpson, or Robert, I think his name was Robert Simpson, an investor from Nevada. He bought all the entire float of a real estate holding company that was publicly listed, and the next day, 100 million shares traded. And so he basically sent a complaint to the SEC saying, "What the fuck? Like, how are shares able to trade if I own all of them, and they're in my
Right.
brokerage account?" And no, and
Just
by the way, yeah, and actually, I should he didn't own all of them. He owned 111% of the float, so he owned more than all of them. So he was like, "How is it possible that literally the entire like multiples of the float is trading when I own the whole thing, and I'm not trading it with anybody? Shouldn't happen, right?" And so
theoretically.
theoretically. And so this started to like what happened is the GameStop quickly became, you know, it quickly switched from a, I would just say like a funny, memeable event in financial market history into almost like an active crime scene investigation where we saw, mathematicians, data analysts, financial analysts, like going through the data and saying like, look at all these anomalies. This is weird, or finding historical examples of naked shorting and predatory practices from hedge funds and saying like, this is wrong. Like, I can't believe they were able to short, 200, 300% of float, maybe more than that. This is predatory, and what they're doing is destroying companies and also obviously putting the stability of the U.S. stock market at risk. And so that's when GME started to switch into almost like a active investigation, and so people just became curious and learning as much as they could about the stock market and the plumbing. And that's when we brought Dr. T on, and Adabit has a series, which I don't know if you're familiar with that stuff, but yeah, we went really deep into the plumbing and we found out a lot of shady shit.
Mhm.
A lot.
Yeah, definitely. I'm actually pretty good friends with Dave Lauer, who I spent a while talking about like the internal mechanics of this stuff in the early days. But the from a trading perspective, I think that's one of the things that's just so fascinating to me because like from the way I look at it is the more money I can make on the movements, the more I can ultimately buy. So it's a really interesting thought process to learn, right? Like they turn off the buy, we turn off the sell. It's very interesting to me. So thank you for the detail there. Cause again, like I really, I enjoy learning about this stuff so much because it's so different from a lot of the stuff that I look at, which is, yeah, kind of boring at this point. It's same day over day.
Of
Um,
course.
Now, when we get into the world, I think I want to say like 3 or 4 live streams with Newton early on before he started. Like he went back to his job and all that. So he's like super busy now. But he was teaching me a lot about like the background, the history, and those kinds of things. So he's kind of been my general scribe for understanding the context here. Now, one of the things that I find so interesting about a lot of the due diligence that I come across is that it, I don't even know how to describe it. It's almost like there's like fucking tentacles where as you're looking at something, you're trying to follow this train of thought. Then there's like this little offshoot here that grabs this other interesting thing. And then this offshoot over here that grabs this other interesting thing.
Mm-hmm.
When you think about like the broader case for GameStop, right? Like the main thing, not going off all the offshoot, the tentacles, but like the main case for GameStop, just in terms of a company and its viability, its future. What do you view that as it sits today?
So I would say there's actually two large aspects of this, right? Obviously, the first is the short squeeze argument. So, GameStop, again, this is where we start to get into maybe controversial territory, because someone who's looking at short interest today will say the short interest sits at 22% or 28% or whatever, wherever it's at. And I would say, sure, that's what the reported short interest is. But if you followed GameStop back in 2021, you remember seeing FINRA data showing 140% short interest.
Right.
And then they found out during that week of the last week of January 2021 that 140% was the technical limit that FINRA was allowed to report short. And
Okay.
other people found other brokers reporting 220% short interest and 315% short interest. So we quickly realized, and that combined with some volumetrics data, And just the amount of FTDs on the stock, we were like, holy shit, they probably shorted multiples of the float. And there's basically no way to close this position. And the argument that other traders had for years, right, was, well, or maybe not years, but for most of 2021, most people who were skeptical of GameStop were saying, look, yes, there was a huge overbuild of short interest. That short interest was evaporated in the run from $10 to 300, 400. It's all over. You guys missed
Just
it.
saying that is
Yeah.
crazy, right? In the run from 10 to 300, $400. Sorry, it just, the numbers sometimes when we talk about this stuff, it never escapes me how fucking crazy that in and of itself is.
Yeah, but it should have gone into the thousands.
Right. Right.
Like I'm completely serious. Like
No, I know.
this,
Before we, yeah.
the CEO of Interactive Brokers, Thomas Petterfee, went
Yep.
live on CNBC on January 28th, and he explained. He was, first of all, he was crying and saying, we need to stop this. We need to, this is market mania. But then they were asking him what was happening. He was saying, like, our settlement system was breaking. Like the FTDs were forcing continuous net settlement to sort of force close all positions. And he's like, if we hadn't turned off the buy button, we would have seen a general stock market meltdown, because literally the CNS, the way it would work
Right.
is, if there's FTDs that are, being forced to close, they'll go to your brokerage account. They'll override even the hedge fund, like their ability to manually trade or input trades. It'll override their ability to manually trade, and it will start liquidating their positions and using the cash, the debits, to fund purchases of GME. And so he's like, with, what was it? I think it was like, man, it was insane. It was like 70% of the float that week was expiring in options. And with 140% reported short interest, but obviously probably higher, around 200%. And with buying at record highs, obviously each of these days was like 80% buy volume. He's like, there was a shortage of like, we're talking hundreds of millions of GME shares, and the float at the time was 80 million. So he's like,
Hmm.
or I think it was 85 million. So he's like, how would you fulfill that? He's like, you can't. So he's like, the price would go into the thousands. And he used the word plural, thousands, for a reason. And so, I mean, we saw, like, this will shock most people, because again, most people don't realize this. Some people tried to do fractional sales on the morning of the 28th.
Oh, right. Yeah, I
And
heard this.
some of these fractional sales sold for 2,600,
Yep.
3,200, and the highest was like 5,200. So they were selling shares for $5,200 in the
Yep.
in the in the few seconds before they turned off the buy button at around 9:30 a.m. Eastern time. So, or I think it's 9:35 or something. Yeah. So like 5 minutes into trading, like they literally, this thing was, it was breaking the settlement system, literally.
Right.
And so that's what people need to understand. Like, this is not a normal stock, and then it's not a normal squeeze either, right? Even Volkswagen didn't see this kind of activity. And so, yeah, this changed the entire market
Now,
infrastructure and everything.
when looking at something like the squeezes, I think the idea of like how far something goes, I get the premise right behind theoretical movements, but I assume people know that governing bodies aren't going to allow a financial system to collapse because of this. So it unfortunately will come at the cost of people not being able to buy the shares or whatever. And it shouldn't happen because of the institutions that are systemically short that are causing the fucking problem. But still, that being the case in the reality, like regulating bodies still aren't going to permit like a broad collapse, right? That's why they stepped in. How do you, like, when you think about that, how does that
Mhm.
factor into the way that we think about GameStop and like future squeezes and stuff, knowing that there is a backstop?
Well, I would say this, right? Like, they would allow they can allow significant damage to take place, but
Yep.
they cannot, you're right, they cannot allow systemic failure. And so
Yep.
what happened in January 2021 was literally the early stages of a systemic failure.
Massive.
And again, most people thought that this was a short squeeze, but when the when the House Financial Services Committee report came out in October of 2021, they looked at the internal SEC data and found that it actually was not a short squeeze. January 2021 was not a short squeeze, and the shorts
Oh
know.
yeah.
And
I
that's
read that. I read that report. It was fucking wild.
it is wild, right? Because that changes everything. It's like, holy shit, these positions are still open and
Hmm.
they're probably unclosable. So you're right. Like, okay, so the financial authorities that be don't want a system-wide collapse, but they
Right.
obviously they can and they will allow large players to collapse. I mean, we saw the collapse of Melvin Capital. We saw the collapse of Citron Research. We've seen Bill Huang's fund.
Hmm.
Was it Archegos? Archegos,
Archegos, yeah.
Archegos, or whatever you call it, which is kind of funny because if you think of it, the way that the fund is pronounced, Arch Egos, it's like
Yeah.
basically it's a kind of a narcissistic name. And then Credit Suisse. And again, all of this stuff, right, like may not have been connected on the surface, but when you look through some of the internal documents, it there's the credits, like for example, the Credit Suisse position with their total return swap position with Archegos, the the notional losses on that spiked in the last week of January and the last week of February of 2021. And so they don't disclose what's exactly in the basket swap, but
Right.
it's obvious that that's GME is one of them. And my conversations with Dario, who's another financial analyst and commentator, also confirmed that he knows people at those banks, and he's like, yeah, from what I've seen, GME was a large portion of the short position of those swaps. And again, it's the problem with the swaps and derivatives in general is that all this stuff is off balance sheet, right? It's opaque.
Hmm.
It's not reported in the same way that most positions are reported, so we can't see it as easily. Not to say that there's nowhere to see it, but even the information we do have is limited. So, but
Well,
yeah, no,
and just one other note on that for people, because I spent a while looking into the swaps for folks, and we'll talk about those a little bit more in a few moments. But I think another problem that people don't understand in general with swaps is that they're highly individualized. So understanding the terms of an individual swap is essentially impossible to comprehend. So, well, it's because it's unknowable to most people. So, because even, we can see if it's something that can be rolled or not technically, but there's nothing that says that that contract can't be closed and a new one can be opened, which is roll.
yeah,
So
yeah,
I just think it's an important note for people because I see a lot of interest in swaps, trying to understand the impact, that it can have on price movement. And that's one of the most difficult parts about using swaps is it's kind of like looking into a little bit of a black box. We have some details, but they're like literally opaque is like one of the best words I can think of for them because they're also very, very modifiable by the two parties that are involved.
yeah, yeah. No, I would agree with that. I would say though that there are general, from my study of the swaps, like there are general like outlines they use. So it's not like
Mm-hmm.
every single swap is a completely new invention with new terms. There's standards and rules and procedures. So it's like most swaps will have the same basic, factors, right?
Mm-hmm.
Same basic formats. And so, but you're right. They're opaque. You don't know the exact terms and you don't know how well they're hedged because again, this is all off balance sheet. And so that's why predicting the price with swaps is very difficult.
Yeah.
Very difficult. Although
Yeah.
it has been accurate a few times.
I've ran a really significant regression on a bunch of these different general ideas, swaps, FTDs on various ETFs containing other baskets, FTDs on GameStop itself, even technical indicators. I was just looking, I ran like 162 standard technical indicators to understand correlations and then regress them. And it's really interesting because to your point, you can always find instances where something will line up, but like the predictive capability broadly is very low, which is yeah, annoying, but is what it is.
Yeah, yeah. But to your earlier point, right? Like, what will happen? Well, I think, there's a little bit of a tinfoil around this, right? Oh, oh, there you go. There you go. Nice.
My wife made that specifically for these. As soon as I hear tinfoil, I have my shit ready.
There you go. I love it. I love it. And the two little horns are great too.
Yeah, it's
Um,
a Viking hat. Yeah.
Yeah, no, look, there's tinfoil, kind of theory out there that Ryan Cohen
For it.
is planning, basically to allow the squeeze to happen again. And what they're working with the SEC for is to prepare the way so that it isn't systemically, it won't crash the entire system. That it'll only wipe out the bad players that they want to wipe out. And
That's fascinating.
yeah, yeah, and
Wow.
there is some evidence around this, right? Like
Can
Brad
you
Cohen is
can I was going to
sure.
say, could you talk to me a little bit more about? I'm fascinated by that. That's crazy.
Yeah, again, this gets into this is the spicy financial tinfoil. I
Dog,
can't
I'm ready.
confirm all this stuff. Um, but I've discussed it with Ian Carroll multiple times, and there's just some weird coincidences. So for one, Ryan Cohen has something called it's called Teddy Corp, which
Okay.
is
Yeah.
basically a bank that he's incorporated, and he's been using that bank to fund loans and other investments into companies. And one of them, for example, is BBBY, and where Ryan Cohen is listed as a creditor. And so the question is like, if Ryan Cohen's focused on GameStop, why is he investing in BBBY, and why is he taking an interest to, Toys R Us? And his Teddy Corp seems to be almost like
Right.
planning to make strategic alliances um with other large companies to basically form like a conglomerate that can fight Amazon.
Hmm.
So like again, you can think like the CEO of Flexport, which is Flexport's a global logistics and shipping company. He and Ryan Cohen have been in contact, and they both follow each other. And the CEO has now started tweeting stuff that's pro GME and pro like Ryan Cohen
Hmm.
in general. And it's like,
Interesting.
well, why, if again we aren't able to have the actual conversations, or no one is like stalking them and has like photo evidence of them together, but there's just enough coincidences where it's like, okay, here we see this bill, this contract between, Teddy Corp or and Flexport, and here we see them follow each other on Twitter and them start to tweet at each other. Like, why would a global shipping company that's mainly deals with like large containers and imports
Right.
exports from Asia, why would he be talking to Ryan Cohen when most, he doesn't really deal with that stuff. GME's GameStop's what's it called? Their supply lines are already set up.
Right. Yep.
They don't need to change anything. And so, because especially video games, like you can produce that here domestically and just ship them to your stores. So you don't need international distribution. And most GameStop stores are in the US anyways, although there's obviously there's some in Canada, I think, under a different name. But yeah, no. So like there's just these weird coincidences that have been popping up. Another one is Ryan Cohen's brother, Brad Cohen, is on Twitter, and he's been following a bunch of GME and then like Teddy Corp people and BBY people. And apparently, can't confirm this, but I've been hearing that he's been talking to people. And so it's like, why is, Ryan Cohen's brother wouldn't be doing this without Ryan Cohen's blessing. And so
Mm.
what's going on? And again, the broader theory is Ryan Cohen basically, so his entire upbringing was, extremely hard work, entrepreneurship, and honoring his father, who has passed away now. And his father was really for honesty and transparency, and had a very strong, instilled a very strong moral compass in his sons. And so that's why with Ryan Cohen's, most successful venture, Chewy, he ventured to take on Amazon. He wanted to stick it to the big man because he thought, and I think he's right, Amazon engages in pretty predatory, business practices, both on the in the you know both on like the employee side, meaning like they take advantage of those employees in the workshops. They give them like 15-minute pee break, or like 5-minute pee breaks, 15-minute lunches. Like you have to clock in, clock out. You're constantly monitored. They time you, and if you're slower than normal, you have disabilities, you get an injury, they axe you immediately. But also on the, maybe more like financial predatory side, there's quite a few famous DD pieces. One of which was called Amazon bust out schemes, discussing how Amazon had worked with Bain and Capital, which is a private equity fund
Yeah.
owned by Mitt Romney, to take over other, struggling retailers and bankrupt them, and then have Amazon come in and swoop up the assets and absorb them. Basically, a way for them to kind of like poison pill their competitors. So they could install, right? Like Amazon could use Bain and Capital to install bad leadership into the boards of these companies like Sears or like Toys R Us. They could load the company with debt. They could drive down sales. They could purposely tank the company. Once it goes into bankruptcy, Amazon, because maybe Amazon is a creditor or they own some shares, they can get first lien and they can buy all their assets for pennies on the dollar. And that way, not only do they take out a competitor, but now they gain all this inventory and assets and storefronts and, square footage that they can now, and shipping trucks and logistics and everything that they can now use to grow their own empire. And so the theory is Ryan Cohen saw this happening. He took them on first in the name, in the sense of Chewy. He built this billion-dollar company that was able to finally defeat Amazon in its own game and just provide better, dog food delivery service. And now he took on like in 2021, he took on GameStop as his new pet project of like taking on, now he's going to take on Amazon in the video game, on the video game front. And his actions with Teddy Corp, for example, investing in BBBY, make people think like, wow, he is combining like a Keiretsu style form of businesses. And a Keiretsu, if you don't know what that is
Yep.
in Japan is, post-war Japan, all these companies would combine together and work together towards common goals. And so it wasn't exactly like you know, a cartel, I would say. It's more like a friendly, like it was like, we're not going to undermine each other. We're going to work together. We're going to try to, because we're all trying to get to the same goal, right? The glass manufacturer wants to make money, the tire manufacturer wants to make money, Toyota wants to make money. And they're like, why don't we all coordinate on import-export contracts, on engineering standards, on et cetera, et cetera, et cetera, so that we can all get the best, make the most money and provide the best value for our customers. And so that's what the theory is that he's doing, that he's conglomerating all these smaller businesses, BBBY, GME, Chewy, Toys R Us. And he's like, none of these individually can take on Amazon. But if we combine them all together and have the global shipping and Flexport and have a bank in Teddy Corp, all of that combined can take a shot at Amazon. And so that's the tinfoil. And again, I'm not saying it's right. I'm not saying it's wrong. I'm not saying anything about it. That's just the theory.
I love me some tinfoil. That's part of the fun of this, is seeing these different dots get connected. Because I mean, I have to wear the hat, right? When I hear a lot of this stuff, I can see how people might be interested in elements of it. But from like, again, I'm a data-driven human. So I see a lot of loose connections, happenstance. From like a trading perspective, I'm not trading off of any of that. But the theories are fucking fascinating. And you cannot help but find some of those coincidental things interesting. Now, whether or not they represent something or don't, it's very difficult to tell, but they're interesting nonetheless. So
Yeah.
that's
And
nuts.
I'll say this too. We do know that like there's legal documents from GME of their of them signing, NDAs and contracts with the SEC for an investigation into naked short selling. So we know that
Yep.
GME has provided documents and evidence to the SEC for a lawsuit on naked short selling and manipulative
Right.
stock market practices. So we know that like those are verifiable facts. I can send you the links after the show if you want to see it. But like we know that they've worked with the SEC in the past, and again,
Right.
the theory is that it's bigger and that all this stuff, it's just they have to hide it behind the scenes until the master plan is ready.
Yeah, interesting. So I want to get to the chat. They've dropped in a few things, and I'm going to start from the beginning. Diego is asking about just talking about GME swaps. So maybe I got to take this off. My head's hot. And I'll wait until we get back into tinfoil to resuit. But
Sure.
could you talk a little bit about just GME swaps broadly? And then Diego, if you're still in the chat, if you have like ancillary details to help us get on target with what you're trying to cover with respect to GME swaps, would love that. But yeah, maybe just start from a high level with GME swaps, how they seem to fit into the picture.
Well, I would say the picture is also bigger than the swaps, right? We had large amounts of out of the money puts, covered call like in the money calls, you know, a lot of derivative action around GME, especially around key like, settlement dates or earning dates or FTD expiration dates that showed us in 2021 that there was something going on beneath the surface. So in March of 2021, um, there was a finance professor browsing through Bloomberg, and he's been published multiple times on Superstonk, and he's produced really good research. And he was browsing some of the more bespoke and strange functions you can find on Bloomberg, and he found a Credit Suisse subsidiary in Brazil that had 70% of the float in uh out of the in the money calls in
Okay.
GameStop, and also held about another, like, 30% of the float, I think it was, in out of the money puts. And so it was like a huge portion, basically the whole float, in options, and it was held in a subsidiary of Credit Suisse. And so people started digging into Credit Suisse. They're like, what the hell is happening? Why is Credit Suisse um why are they holding this many derivatives? And then what happened is, people started, he asked Bloomberg, he said, is this correct? Like, am I seeing 80 million shares worth of options um, on GME held in a Brazilian subsidiary? And 24 hours later, and luckily he documented everything. So he took video, images, and he sent them a chat, and 24 hours later, all of that was deleted. And he got a message saying that those options were an erroneous filing, and that it had been resolved, and that he didn't need to ask any more questions.
Mm.
And so that was like the first sign, like, what's going on. So that's when we started digging into Credit Suisse. And luckily, about a few weeks later, or maybe say unluckily for them, Credit Suisse started to enter bankruptcy. And the reason why was because of Archegos, which had failed in, early to or mid to late March. And Archegos had opened up total return swaps with a variety of counterparties. And when Archegos went under, because they went long on Viacom and Paramount, and then a bunch of other Chinese stocks, um, when they went under, the large prime banks on Wall Street had a closed door meeting to figure out how to unwind this mess, because they didn't realize that Archegos had levered its book, 25 to 1. It
Hell
was it was
yeah.
opening up derivative positions 5 or 6 times its
Perfect.
equity value with every single large Wall Street bank. So it was like, obviously Credit Suisse, JP Morgan, Goldman, and then Nomura as well. And I think there was Bank of America. And so they had this closed door meeting. They said, okay, well, how do we unwind this stuff? And JP Morgan and Goldman told everyone, they said, well, here's what we're going to do. We're going to slow unwind over 6 months, do small block sales of these swaps, or like trying to unwind them slowly, so that we'll all do it at the same time, holding hands. Trust me,
Mhm.
bro. And they said this was like, a Friday in late March. They open a business next Monday. We start to see giant block trades in the dark pools for Viacom, Paramount, GME as well, and obviously all these Chinese stocks. And quickly news came out, like, a day later, holy shit, Goldman and JP Morgan reneged on the deal, and these guys they told their traders to dump everything and get out now. So this is how the banks work, right? They're kind of predatory, but
Yeah, man.
Credit Suisse got stuck with the bag. So all these swaps, collapsed in value, and JP Morgan, Goldman got out, Nomura took a hit, and Credit Suisse was left with a huge bag. And that's part of the reason why they failed. Not all of it, obviously, but I think that was the main, it was the straw that broke the camel's back. Credit Suisse already had issues that had been lingering from 2008, but this was the final, killing blow that really destroyed them. And as Credit Suisse was unwound over April, May, June of 2021, there were lawsuits that came out, obviously, and the lawsuits in the discovery process produced a lot of evidence showing that Archegos had been shorting, like I said, GME. In some of the calls with the Goldman broker, an Archegos managing director was recorded as saying, we need to make sure we short these retail stocks. And then she said, "Are you sure? Do you mean GME?" And then he says, "Absolutely." And then they go on, and they don't specify. The problem is we don't know, again, because of this, the limited amount of information on the swaps. We don't know how many exact shares. We don't know how they were hedged. But if the Credit Suisse numbers are to be believed, Credit Suisse alone was counterparty for 70% of the float of GME in swaps. And they had hedged that with out of the money puts. So options.
Well, I think the other problem just with trying to draw linear relationships like that is we also don't know what the rest of their book looks like, right? So we can see what the swaps show us, but we have no idea what the rest of the broader book looks like, which is difficult to piece together.
Totally fair. Totally fair. And that is
Yeah.
true. And, but I'll say this, Credit Suisse required like what was it, like a $30 billion bailout from the Swiss National Bank, and they had the Swiss National Bank absorb most of their toxic assets, and even then UBS didn't want to take them on. And even now that you see articles like, there's a recent one where UBS was trying to sell off a bunch of toxic Credit Suisse assets and had to take a 60% write-off on basically all of it. They had to wind down their commercial property unit, their commercial real estate unit that did MBSs, CMBSs. And so yeah, we don't know the entire extent, but we know that it was bad. It was really bad. And if those numbers are to be believed, 70% of the float with just Credit Suisse alone also implies if Archegos had copied this strategy with other brokers and done the same basket swap, going long some stocks and going short others, that means there are more shorts out there. And we also know, again, from Dario, from evidence from Dario, that in Asia, he's a former Citigroup structured equities trader, and
Okay.
he was saying that in Asia, he knows that there's at least two other hedge funds that were following Bill Huang and Archegos tick for tick. So he's like, there's at least three of these guys in Asia, and there's probably a dozen more elsewhere that had followed him headlong into this basket swap trade because it seemed like free money, right? And to be fair to them, right, if you put your morals aside, it
Fuck
makes
those.
sense. Yeah, yeah, fuck the morals, but like, it kind of made sense. The year is 2020, right? March 2020. The stock market's collapsing. COVID's hitting. The Fed is panicking. Everyone thinks that the shutdown is going to last forever, and everyone thinks that coronavirus is the worst virus to ever, the worst pandemic to come since the Spanish flu of, was it 1917 that killed 10% of the world's population or whatever it was, killed millions of people. The panic that sets into markets is, unprecedented. It's the first time we've seen, broad-based equity markets melt off like that since 2008. And
Mhm.
the hedge funds realize, like, look, a lot of these retail stores, these brick and mortar retailers, they're not going to get any traffic. And if they don't have an online presence and they don't have a viable e-commerce business line, they're not going to be able to make any money. And so they're all going to zero. And so it makes sense to do a basket swap that goes long whatever equities you want to go long, whether it's Zoom or, Tesla or Facebook, all the tech stocks. And then you can go short, GameStop, right? BBBY, Sears, whatever, any large retailer you want. And if you have any sense, you want to put pressure on these trades. So you want other people to be in with you. So you have idea dinners where you tell other hedge fund traders the same thing. And again, you're not coordinating, but you're just sharing ideas. And if they so happen to do the trade and they're making 8% a month on it, they're going to love it too. And so you can quickly see how multiple hedge funds start to pile in to this trade. And this matches, right, the House Financial Services report, which found there were over 70 hedge funds. And again, they won't name them, which is unfortunate, but there were over 70 hedge funds short GameStop and 175 retail brokers that shut off the buy button.
Mm.
And so we don't know how big this monster is, but we do know there's a lot of evidence on the swaps showing that Archegos and several hedge funds in Asia for sure, and then most likely dozens of other hedge funds across the US and Europe went short GameStop via swaps. And then the reason why we saw this, the reason why this kept popping up is because we started to see correlations with some of the swap expiration dates and the running of the stock price. Because again, like we said at the outset, right? GameStop is not a stock that follows any typical trading, indicators, right? It does not follow rise decline. It does not follow RSI necessarily. It doesn't follow any of that shit. And we've seen days where, you think nothing's going to happen. Like I said, February of 2021, March of 2021, this May and June run up was another good example. If you had said in a week and a half, GameStop's going to be at triple the price, a normal person will look at you like, what the fuck? What's the catalyst? Oh, by the way, there is no catalyst. No news comes out. It just rips 200% for no reason. And then no one knows. And then it goes back down and no one knows why. It's like, well, hold on. Unless retail is collaborating and has more capital than we ever thought they did, this has to be something else going on. This has to be something happening with the plumbing of the system. And so again, the working theory is they've been using these swaps to get rid of FTDs, to kick the can down the road, so to speak, to not have to settle the massive obligation that they've built up since 2020. Because from what Dario has shared with me, a lot of these swaps were entered into in March 2020. So they all got the bag in March 2020. They thought it was just going to print and make money, and it's gone the opposite way. And so they've had to find new creative ways to keep kicking this can.
Interesting. And there was a follow-on question from Diego and Corey with respect to Chewy swaps. So I've seen a lot of interesting theories around Chewy's GameStop relationships, the swaps as well. Is there any connection between those as far as you see it?
So I actually had someone reach out to me about this. This is really interesting.
Okay.
So on some of the basket swaps, you can see two different legs, which can make sense, right? Like some of these, like the leg can mean the receiving or the sending pair. So you can hedge it. You can do a swap either way, where you're either promising to deliver shares or you're getting a promise to receive shares. And so if you're promising to deliver shares, then obviously you would want to be hedged. And one of the ways you can hedge is via the options market. And what we saw in some of this data that this unnamed gentleman shared with me is that on a lot of these swaps, obviously, you see GME on the first leg of the swap. So you see, notional amount, and then you see like tickers, and it'll include like 6 or 7 tickers. And some of these tickers are really weird. It's like, I would never think like it's a gold, like Barrick Gold Mining, or like, some French banks. You're just like, why is this included? And again, we don't get any answer, but a lot of them will have GME on the first leg of the trade, right? So that's basically like a promise to send those shares out. So those, that would have to be hedged. But then on some of them, again, some of them, the data is they don't release the second leg, the data for what's the second leg. On some of them, they don't have data on this first leg. So it says promise to receive. And on the receive, some of them say Chewy.
Mm-hmm.
And a lot of them that are correlated are the ones where GME and Chewy are included in the same basket stock and treated the same by a single counterparty. But the problem is, again, we don't know who that is. And we don't know how well it's hedged. But from what I had seen from the data, there were a bunch of Chewy swaps that are expiring in late September of this year. So it's just, a week ago. And I haven't really followed the Chewy swaps that much more, because for me, my main focus is GME, because in my opinion, and I think most people would agree with me on this, GME has overall a more interesting and compelling story to investigate than Chewy. But yeah, there's been, from what I've seen on the data, there's been significant correlation, like especially that first and second leg. A lot of, sorry, a lot of times where Chewy shows up as a receiving leg of a swap.
Yeah. Okay. Got it. And that makes a ton of sense. I've seen the same thing actually myself. And again, the world of swaps, I think it's so interesting because of how dynamic they are. So because I just continue to reiterate that point for people, because I think a lot of times when people are analyzing them, they try to create direct parallels. and causal relationships, which is very difficult. It's so difficult because a lot of these entities will have an amalgamation of different kinds of swaps and derivatives in their entire book. So it's really hard to see what offsets what. But the relationship that you highlight there is, I think, important for people to understand, at least with respect to how a lot of these things are seemingly very tied together. Because one of the things I've done with any sort of correlation analysis is the correlation between a lot of the products isn't really that unique compared to the correlation of most beta products. But what you will find is the correlation between them strengthens during big moves.
Mm-hmm.
That's noteworthy. So as soon as that standard correlation starts to expand during those kinds of movements and then break down post, I think it highlights some movement that happens behind the scenes, because that's really what drives any sort of correlation analysis for different time frames. So I find that interesting.
Yeah, they did a study too. I can send you the paper. There was a paper out of University of Brno in Eastern Europe. I forgot what countries. Maybe it was
Oh,
like
I've read. I
Hungary,
literally
Romania.
read that one.
Okay,
Yeah,
so
because
you've read that. So you
yep,
saw the correlation between GME stock price, short interest, and ETFs.
yep.
And whenever whenever the stock price rose, there were 16 ETFs they identified as highly correlated, where the FTDs in the ETF increased along with the GME stock price. So it's and the borrow rates, right? So there was evidence that they were abusing, the hedge funds and market makers and others were abusing the ETF mechanism as a way to get shares, and they were causing FTDs in these derivative products like ETFs, just because they wanted to get away from the hot potato of GME.
Yeah, well, and then the creation redemption cycle on those ETFs is also, I think, a big part of that story. Now, one admin note, because I remember I was talking with Newton about this too, and I am no significant advocate of market makers. I have a friend that's a market maker, but I'm not like an advocate of them. But sometimes I feel like their role is grossly misunderstood in markets. So what role do you see them playing from your perspective with GME specifically, to be clear?
Sure. And actually, I got corrected. I just got some Twitter DMs. I did say, the regulatory bodies turned off the buy button. That's an oversimplification. Really, it was clearinghouse, Apex Clearing,
Yeah,
that
exactly.
shut off the buy button.
Yep.
Yeah. So when I said regular, I'm more broadly meant like the powers that be, the people who
Yeah,
are
it's
running the plumbing of the system.
yeah, I knew exactly what you meant. Yeah.
Yeah. So apologies there. But sorry, what was your question again?
It was about market
train of thought.
makers, their kind
Oh,
of their role with GameStop.
yeah. So I've actually put together a couple good Twitter threads about this. Actually at my prior company, at the fintech company I was working at, they were trying to create a private market exchange, essentially allowing people to transact shares of private companies on a limited basis. And so all this involved discussions of what is liquidity, what is a market, what's the role of a market maker, what's the role of an exchange, what's the role of a transfer agent, how should all this work? And my view quickly became, especially with, quickly like learning about the naked shorting mechanism and the FTD rules and the loopholes with ETFs, that market makers can abuse, the authorized participant loophole, that our current ideology around market making is completely broken. In the current market paradigm, liquidity is viewed as everything. So
Mhm.
it's like all you want to do is maximize liquidity. So
Mhm.
the idea is, right, whether it's shares or even just money itself, the idea is we need to maximize liquidity, keep everything running, because if things fall apart, then there'll be economic pain. And that can happen either on the buy side or the sell side, right? If you run out of liquidity on the buy side, the stock price can fall. And if you run out of liquidity on the sell side, then the stock price can rip. And that is true. And I'm not saying that there isn't an argument for liquidity in general, but to maximize liquidity as your primary North Star that your exchange or your software is pointing towards is completely broken. Because what happens when you start maximizing liquidity is you start minimizing the importance of every other factor, and you destroy the ability of of a market to function properly anyways, right? If you want infinite liquidity, then just have an infinite share printer and an infinite money printer that just battle each other forever and
Do you think
get rid of the reason for even people existing. But
do you think that the well, how do you explain the nuance between infinite liquidity and trying to maximize liquidity? Because I would argue those are slightly different concepts.
yeah, and I'm being a little, bombastic,
Okay.
right?
Just for the
With infinite liquidity, but the point is their goal is to increase liquidity at all costs.
Yep.
Like that's how the current market paradigm works. And that I think is a very, very bad premise, because what ends up happening, right, is you get justifications for um, all these abusive market practices, naked shorting, FTDs, ETF loopholes, options, off-laying settlement. You essentially get to a system where all shares never have to be delivered and they can be kicked with FTDs forever. Because again, it's liquidity. Hey, we can't deliver
Mhm.
the share. We need more liquidity. We need to not let it be sold, because then the price would be depressed or the price would rise if there's a lack of shares. So we need to let the liquidity fairies do their work and keep kicking this can down the road. So
I see.
the current system, the way I would change it, which again might be controversial, is having like a very different approach with supply and demand, and the idea of like, if a stock price starts running and there's not enough shares, the price will go up until there's no more sellers of shares, and then it just freezes. And we would just watch, oh, Apple's at 2000. Why hasn't it moved? Because no one's willing to sell and no one's willing to buy higher. So it's just frozen. And once more people come in, then it'll change. And so the market, under my view, maybe would look a lot more jittery, but I think it would reflect real supply and demand. And once a broker runs out of shares, that's it. They're done. They can't do this. And all of this, by the way, is possible, because here's the thing: is the DTCC runs all of the share and trade settlement through a massive SQL database, right?
Mhm.
They have centralized insight into, through their DTCC account, they have centralized insight into the positions of every single broker and, market participant that there is. And so why can't they solve this problem? They can. And Suzanne Trimbath said that they're able to do it. It's a lot of work, sure. They have to change some problems with the system. They have to probably, they have to eliminate the ability to naked short. They have to get rid of FTD bypass rules, but they can do it, but they won't, because the system as we know it would grind to a halt. It'd be much more liquid.
Yeah, because I hear some of your points. I definitely can see it would be very difficult to implement something that like that specifically from a liquidity perspective, but it's an interesting idea. And I think one of the other things to note though is like the idea of naked shorting is kind of like a perversion of the rules. Like that's actually side skirting around existing policy. I'm not so sure that that's something that we being again governing bodies, but specifically regulators, are attempting to promote or promulgate for the sake of liquidity. I think it's something that's happening, but I don't think it's something that is supposed to be happening.
Well, market makers have a naked shorting exemption, right?
Of course, but
Yeah.
their mandate is slightly different because they have a covering window, and the premise for them naked shorting is completely different than the premise of institutions naked shorting. So for them, to your point, market makers, it's for liquidity. For institutions, it's because they're trying to be cheap and they can essentially gain exposure to things otherwise they might not have access to way, way cheaper.
True, but at what point does liquidity start destroying price discovery? Again, like, if this is the issue. It's like, okay, so let's say we get rid of naked shorting from other institutions other than market makers. Okay, so market
Mhm.
makers are the golden boys of Wall Street and they can naked short all day long.
Mhm.
What's to stop them from being the monoliths of price discovery? So they can now say, oh, well, hey, Apple's rising. We don't like Apple. Our clients are short Apple. We're going to naked short a ton of shares today, and we're going to kick them with FTDs and never deliver the shares and sell people a bunch of fake phantom shares and make sure the price doesn't go up. And what are you going to do about it? Because we have an exemption. Like once you open the door, it's one of those things where it's like, give them an inch, they'll take a mile. Once you open
I
the door
agree.
a little bit, you can see how it becomes so logical. It's like, well, why wouldn't we do this? Why wouldn't we just naked short every single
The
stock?
I think it's just important to remember the game of market making, right? Like they're typically not managing a book for a client. They make their money by providing markets. So their entire job is to offer you a bid-ask spread at a size so that you can trade what you want. I understand your point fully, but it's just the way they make a living, they're much more kind of like a scavenger of the market as compared to an entity that is moving as that specifically.
I would disagree with you. So that I would say that that's how it should be. But if you look
Mhm.
at the actual structure of the market right now,
Mhm.
Citadel Securities is a market maker. Citadel
Completely
itself
different.
is a hedge fund. Now,
Right.
those are both owned and run by the same people.
Completely agree.
And
Yeah, no,
Citadel
and in that example, I
yeah,
completely agree with you. Yeah.
and Citadel, the hedge fund, shuts down, or Citadel, the hedge fund, extends a $2.3 billion loan to Melvin Capital in January of
Mm,
2021 to bail them out of their underwater GME shorts, right? At this 2 days later, an unnamed market maker causes a, clearing, I guess you'd call it like error within
mhm,
Apex to force freezing of buying of all the meme stocks. Because what happened is somebody made this is trade 385. Some unnamed market maker, but we assume it's Citadel because Citadel was the designated market maker for AMC and GME.
and they're
Um
just everywhere.
and they're everywhere. They're basically the largest market maker. And some unnamed market maker made a $385 million buy and sell trade for AMC in the evening of January 27th. The next day, 28th, the Apex Clearing realizes what's going on. They say, holy shit, there's a massive buy and sell. And under their own, internal rules and regulations, whenever there's a massive buy and sell, one of the legs of the trade must be manually verified. And whoever had made the trade had not manually verified the sell side. So whoever this market maker had logged a buy for $285 million worth of AMC and then not manually logged the sell. So the sell was in the system, but it wasn't manually logged because through this internal rule in Apex Clearing, and maybe it's true of all clearing brokers, I'm not sure. You have to make if a large sizable trade is made within 1 second, you have to manually verify the trade, which makes sense, right? It's like it's buy sell within the same second. Is that an anomaly? Is that a mistake? Was one side of the trade not meant to happen? What was supposed to go on here?
Mhm.
And then the entire stock market, freezes, and we see all the meme stocks have no buying available for them. So the conflict of interest here you can immediately see Citadel Securities has the ability, potentially, again, alleged, none of this is
Definitely.
confirmed, but potential ability to log buy and sell trades, massive ones, force, basically like a technical default on the clearinghouse and force them to freeze buying for all the brokers. And then on the other hand, they have their hedge fund saving Melvin Capital. So it's like,
Mhm.
would the guys at Citadel Security help out the guys in Citadel, the hedge fund?
Sure.
Probably. And it's
Yep.
not far-fetched to claim that. And that's the
No, I
problem
don't
with a
think
lot
so
of
at
these.
all.
Yeah, that's the problem with a lot of
Yeah.
these market makers is that they're not these neutral arbiters of value. A
Well,
lot of them have vested interests one way or the other.
there's three of the big ones that operate also as hedge funds, right? So you hit one, there's two Sigma, and then there's Susquehanna. And then places like Flow, GTS, Jane, Virtu, those are strictly market makers. So
Exactly. And that's another thing, right? The SEC should look at. Why are these
massive conflict
people?
of interest. Massive,
Yeah. Why are they
massive
allowed
conflict
to
of
be
interest.
run a hedge fund and a market maker? That's
Yep.
insane.
Yeah. No, I completely agree. I think it's straight bullshit.
Yeah.
Um, so there was a question in here before from one of my favorite usernames that I have the pleasure of seeing when I do live stream, which is Roaring Titty. Big fan of that
Oh.
one. So we have a Roaring Titty, and then there's normally a Roaring Clitty. I like both
Oh
of those.
God.
They're a dynamic duo. But Roaring Titty was asking, I have to find it because I don't want to miss it. Was asking about, yeah, here it is. What about Carl Icahn getting into those swaps in 2020? Do you know anything about that? And while you're responding to that, I have to grab another water. So feel free to kick off and then I'll be back in like 2 seconds.
Sure. I haven't looked, insanely deep into the Carl Icahn connection. From what I know, he had gone into the swaps, um, and potentially was even short GME in 2020. But Ryan Cohen's apparent friendship with him and pictures with him and overall admiration of the guy makes me think that there's something deeper going on there. So sorry, I don't know a ton about it because I haven't looked into Carl Icahn that deeply, but I do know that he was allegedly in the swaps shorting in 2020, which maybe he's changed his tune and maybe he's gone long, or closed his short position potentially.
Yeah, because when I saw about Icon, I've heard of that before, but I never fully understood what his position was. Roaring Titty saying I thought he got smashed with the GME shorts. Is that
That's
true?
that's what I've seen. Yeah. But
See if
but
we
what's
can
strange,
find
what's
that.
strange, like I was saying earlier, is what's strange is why is Ryan Cohen so buddy buddy with him? Why does he cozy up to him? And I would think that probably Carl Icahn changed his tune, closed his shorts, and then now went long. That's the most likely explanation. But the saga is not as clear cut as you would want it to be, right? There are players with mixed motives, and so Carl Icahn might be one of them.
Yeah, so I just asked ChatGPT, so I always frame it that, right? Because I don't know how accurate it is.
Mhm.
But ChatGPT looked at two different websites and it says Icon profited from shorting GameStop during the peak of the frenzy in 21. Despite these, Icon experienced broader losses with his overall short positions, contributing to 1.3 bill in losses in 21. So while the exact amount Icon made on the GME short is not publicly disclosed, his gains on GameStop did not offset the other losses. So it's hard to, it's essentially a non-answer. It doesn't tell us
Yeah.
what he would have done on the short side or even on the long side.
Yeah, and I
Kind
also
of
know
interesting.
a lot of hedge funds did go short at the top at
Yeah, I mean,
$300.
it's super logical to be honest. Again, from a trading perspective, trading both sides of squeezes. I have a video that's coming out soon that talks about like the anatomy of a squeeze because the way that I think about trading is I break things down into I call them profit mechanisms. Like what is this specific thing that lets me make money? And short squeeze or gamma squeeze, short squeeze don't really care what causes it. Maybe better just to call it squeeze, but there's very specific conditions and behaviors of squeezes that you can trade, but one of them is the periodicity. They're typically very, very short term. So they're really, really, really tradable events. It's kind of like if you see massive spikes in VIX, it's another highly tradable event. Yeah.
Yeah, I actually used to trade UVXY, like
Yeah.
the
Yep.
leveraged. Yeah, it was fun. It's fun. You can make a lot of money and then you can lose a lot of money very
Yeah.
quickly.
Well, that's the beautiful part about markets, right? Is like it's just this game of taking money out of the machine and then just giving it back. And then you look at it and you're like, well, fuck, I need to make that back again. So then you go back again. And here you are in the virtuous cycle of trading.
Yeah. Well, this is the
Happens.
issue, right? Like markets have become a gambling mechanism. And
Oh,
I
it's
think,
gamified too.
yeah, it's gamified, but it's become a
Yep.
gambling mechanism. And again, because why? Because we've allowed the derivatives and the higher order functions of the market to supersede the actual market itself, right? Because
I
again,
see.
let's go back to the original argument about
You mean
liquidity.
as like a price discovery mechanism?
Yes,
Yeah.
yes.
Okay.
What's the primary role of a market? To be liquid or to have price discovery?
Right.
You can't
It's the
have,
latter. Yeah.
yeah, it's a spectrum where it's like if you go further down the liquidity side, you're giving up price discovery. And so if you want markets to be truly, truly price discovery, you would have to put in a bunch of restrictions that are not in place today. You'd have to eliminate naked shorting, eliminate FTD loopholes, all that stuff. But more so, you would have to limit derivatives. You would have to say, look, like there's 100 million shares of the float, 30 million owned by retail, 50 million owned by institutions, only leaves us 20 million. We're not going to allow more than 10 million shares in terms of options to be sold. And if that
Mhm.
limit gets reached, hard stop, no more options can be sold. Those are the restrictions that would have to be put in place because again, you couldn't have a market where the derivatives have a claim on more shares than actually exist.
Right. Well,
It
I guess the only
yeah.
problem with that is if you look at the way that derivatives are typically resolved, it's not through the movement of the underlying. So I fully understand your point in terms of essentially making it so that it would be secured by the underlying itself. But the overwhelming resolution of derivatives is trading in and out before expiration. It's just for
Cash,
leverage.
you're right, it's cash settlement. Most derivatives are. But again, so here's another systemic risk of markets. What happens if
Yeah.
everyone exercises?
Oh, right. Yeah.
What happens? It's the same thing what happened with Nixon in 71. What happens to all
Yeah.
these gold certificates if people actually call your bluff and say, I want the gold? What happens to
Yeah.
all your GME options if everyone says, holy shit, you guys are manipulating the market? Well, no longer do I want to trade my option and get 20K. I want my shares and I want them now. And I don't give a
Mhm.
fuck about the money anymore. I want to stick it to and I want to hold these shares. Because that's what happened. Like in
Right.
2021, people started exercising their options. They didn't sell them. No one wanted to sell. Everyone's like, give me the shares. I want to stick to Wall Street. And so
Mhm.
and their models don't account for that. Their models will say, oh,
Of course.
2% of all options will be, exercised for shares or 10% or whatever the number is. It's a fraction
Sure.
of the total. What happens
Yeah.
if 50% of them say they want to exercise, which is a non-zero probability? So these are the restrictions you'd have to put in place on a market that was strictly based on price discovery and did not maximize liquidity. Because that kind of a
Well,
market with a fixed share count and forced settlement all the time, you can't have options running amok.
Well, and the other funny part there is as I think about your theory, that's really fascinating is if you consider the fact that, when options are in the money coming up on expiration, right? Market makers are typically going to hedge with the underlying expecting to deliver. But to your broader point, if people that are out of the money just decide to exercise and get their 30 shares on their 30 deltas or whatever, or, whatever the equivalent would be at that point in terms of what they would like, that's fascinating because yeah, you're right. That would be a massive stress test. But I guess the reason why we think about it the way that they do in terms of markets is just it's completely irrational. Again, to your point, if the rationality is to stick it to Wall Street, now that's a completely different angle that I don't think a lot of people have considered too widely.
This is part of the broader issue. So this is the philosophy of markets, which I've studied a lot
Yeah.
of actually. This is part of the broader issue with how financial education, economics education is taught. We're taught from day one of any college course, either undergraduate or graduate course, that markets exist with a random walk and Brownian motion is the key governor of, price movements. What is Brownian motion? Brownian motion is the idea of random motion of atoms or cells or almost any entity in what's called a non-dynamic system in physics.
The, just
So,
one quick admin
sure.
note. We're talking about a theoretical concept because obviously we
But
know
it's
that markets exhibit geometric Brownian motion tendencies at points, but it also has things like drift, right? Positive drift. So that's not Brownian motion. That's long-term drift. Just highlighting for the audiences that are listening that there's like different levels to the concept.
yes, obviously, but the problem is the theory of markets, like the EMH, for example,
Right.
efficient markets hypothesis, that's based on Brownian motion being
Mhm.
valid and true at all points continuously across all asset classes. And it's
Right.
also based on, some things that are nonsensical, equal and true information given to all participants simultaneously, infinite
Right.
liquidity,
Yeah.
like the seven tenets when I was in college and the professor laid out the seven tenets of the EMH and he had us study it. I looked through it on the first day of that class and I was like, what the fuck? All of these are wrong. Like literally,
Right.
there's not
Yeah.
a
It's
single one here that's correct. And I'm like,
exactly.
how are you teaching? Like, it's irresponsible. You're lying to us. How is this right? This market isn't efficient. And the more I read and the more I researched, right? Oh, our stock markets duly portray Brownian motion. And it's like what you said, maybe at certain points they do, but for the vast majority, they do not. And the issue
Right.
is when you build all your mathematical models around Brownian motion and a geometric mean and normalized data that's safe and easy to understand, you create algorithms, you create trading patterns, you create things that work 98% of the time, but then absolutely blow you out of the water 2% of the time. And those times it blows you out of the water, and if it does so in a big enough way, it can cause a systemic crisis. There's a really great
Sure.
book on the 1987 crash called When Genius Failed, I believe it is.
Yeah. Yeah.
I
It's
don't
a
know if
good
you've read
book.
it. Yeah.
Yeah, definitely.
But in that book, they describe, right, like how this crash happened, right? How that portfolio insurance and the derivatives and the interplay between the SPY futures and the portfolio insurance were kicking in, and they were shorts, and then the short arbs would come in and short the underlying stocks, but then buy the futures, and then as the futures tanked, they have to sell more of the futures and keep shorting the stock. It's like it was a negative feedback loop, right? Or I should say a positive feedback loop that worked negatively to drive the market down and cause whatever it was, an 8 sigma event. And the mathematicians who went back and used those normalized distribution, bell curve, Brownian motion models, they found that the chance of Black Monday happening using those models was
Right.
1 in 10 to the 160th.
Hmm.
Now there are 10 to the 80th atoms in the universe. So 10 to the 160th is a number that's so astronomically high, it's not even possible. So that's why no one had hedged for it. No one thought that a 22% decline in the SPY could happen on a Monday. They said that's impossible mathematically, but it was.
Well,
So clearly those
just
models were
another
wrong.
yeah, just another admin note on that. Like the stuff like efficient market hypothesis is a framework for thinking, right? It's like institutions aren't actually building models off of that. They know better. It's the same thing with like Black-Scholes and option pricing. If we look at option pricing, Black-Scholes Merton model assumes volatility is uniform across all strikes. We know that's not true, so on and so forth. It provides like a framework, but anybody that's interacting with markets at a professional level, they're not going to actually build models off the framework. Now, to your point, they were still completely offsides for that move, for sure, no doubt. And I completely agree with you there. But
Well, they talk about this in the book, but post 1987, that's when people started to doubt the EMH and serious concerns were raised about this. And then they, obviously there was that, I don't know if you read one of the last chapters called Volatility Smile.
mhm,
Ever since 1987, they've seen a uptick in the convexity curve of volatility. So it's
yep,
like at the very extremes, for extreme movements, you have to pay more than for a middle extreme movement, if that makes sense.
right.
So
Yeah,
there's this
absolutely.
convexity with options or with futures or with swaps or whatever it is. So it's like it would cost more to hedge a 20% downside move, than a 10% downside move, even though the 10% downside move might be more probable in the
Yeah,
SPY. And
exactly.
so,
Yeah, and
yeah.
it's also a big reason why we see volatility risk premiums or variance risk premiums. For those that trade options, you'll be familiar with that term, where we essentially we especially in the indices. This is a little more dynamic with respect to individual securities, but we essentially always overestimate implied versus realized volatility. It's literally for the same stuff. Because it's like if you read Taleb's work, he talks a lot about the probabilistic outcomes of things. And actually, in my undergrad and grad, I focused on stats just because I'm fascinated by perceiving the world that way. But markets are interesting to that note
Mhm.
that improbable events happen all the time, literally all the
Mhm.
time. And it's why we see things like fat tails, kurtosis, and the overall skew. So like we know for a fact we're not looking at a normal distribution curve, right? It's definitely not normal distribution when we're modeling things, which is always curious to me, especially if you look at like GME price movements. That's I modeled the price movements in GME out of curiosity, and it's insane like how skewed it is. It's fascinating to me.
Yeah, but that again, this goes back to the argument of static versus dynamic systems. The stock market
Right.
as a dynamic system, all the factors affect other factors, and the
Right.
the coefficient between those two factors changes over
Yep.
time, and it's
And
impossible.
relationships. Yeah.
Yes, these complex systems are impossible to model. My
Yep.
dad is or he's retired now, but he was an atmospheric scientist, and he
Cool.
worked for a time at NOAA,
Yeah.
to model
National
to do
Oceanic Atmosphere. Yeah,
ocean exactly, and he was doing climate modeling, and they were trying to
that's so
predict what the
cool.
Earth's climate would be like in 20 to 30 years, and he was telling me that there's literally like 50,000 variables, and
Right.
after just a few years, the error bars and the variables grow so large that it becomes useless to predict. And this is the same reason why, for example, weather prediction models can only predict the weather for accurately for a week or less.
Hmm.
And you can't predict the weather out for 3 weeks. Why is that? Well, it's because the climate is a dynamic system, and all the factors impact other factors, and the relationship between them changes constantly. So it's literally impossible to model. Like mathematically, you would
Right.
need infinite computing power to model.
Literally.
Yeah, literally
Dude,
infinite.
that's so cool. What a cool job. And did he travel a lot for that?
Yeah, he did work in Chile, and
Yeah.
he also worked in the North Pole and the Arctic. He did some climate research up there, and like
Did he
I
bring
think
you
that
back like letters from Santa and shit?
no, no,
Damn.
no. But he was up there, I think, in like 1994 doing research on ice crystals and uh prehistoric, air bubbles trapped in the ice, trying to model
Dude,
what was the climate like back then.
I literally was just telling you before we actually went on the live stream how much I like old shit. So as you're talking about prehistoric ice bubbles, you have no idea how. I gotta talk to your dad sometime because that stuff is
Yeah, sure,
that's
sure.
so
You can we can
dude.
we can set that up.
That's so fucking cool. I love that stuff. But yeah, it's funny because Chile, beyond investing like in the stock market, I got into real estate over the last like decade or so. So I work with a couple partners and we actually scooped up a couple ski resorts in Chile specifically. There's like a trio mountain range, and we just grabbed a second resort that we're going to combine into like a bigger joint resort, which looks really cool.
You bought a whole
Yeah.
resort?
Yeah, yeah, it's not just
Wow.
me. We have like a partnership that works in them. But yeah, ski resorts is a big thing that the partnership does. We do a lot of odds and ends. So like we just grabbed a couple golf courses last year. That was like a first add to the portfolio. Never did those before. I don't even like golf. But my buddy does. So I was just like, yeah, like I'll ride with you. As long as I can drive the carts like fucking blackout drunk and be super irresponsible, then I'm there for it. And then we have like some general staples like apartment complexes, student housing, stuff like that.
Okay. Wow, that's really interesting.
Yeah. So a couple other questions from the chat because Brilliant says less Eric, more Bull. So I gotta shut the fuck up. Um, obviously, I don't give a fuck what they say, but it's
Wow.
funny. Yeah, funny line nonetheless. But this is super interesting. So Jerry says, why would retail want to give the brokers market maker liquidity? Wouldn't retail want buyers to want what we are selling instead of creating fake liquidity to move the stock in the direction they want it to be? Did you follow that? Do you want me to post it in our chat? Yeah, that's a lot.
I don't fully understand what he means by that. How would retail create liquidity on the sell side? Is that what he's arguing? Like,
Yeah. So Jerry, could you clarify your question a little bit? Jerry says DRS takes liquidity from financial terrorist broker market maker.
yeah.
I love that. I love that. Yeah, I'm trying to follow the question, but why would retail want to give the brokers, market makers liquidity? Wouldn't retail want buyers to want what we are selling? So I assume they're talking about DRSing specifically. Like if you DRS, then you're reducing the ability for people to buy those and move the price. I don't know if that's fully accurate. That's my best interpretation.
Yeah, so that was the thesis behind the push for DRS, right? Is market makers are dipping into shares, and the DTCC is allowing them to dip into shares at brokerage accounts. So if you own, and this also became with a bunch of revelations around, there's Goldman and JP Morgan and B of A, all Merrill Lynch, all these brokers were found to have multiple violations from the early to mid 2000s, where they allowed their own traders and other institutions to dip into the personal accounts of their clients. And even if they were cash accounts, which are technically not supposed to allow, um, you know, stock lending, right? So this problem quickly became a concern because the question was, right, if we're buying GME and we're putting them in our Fidelity, or we're putting them in our, Roth 401k managed by Merrill Lynch or managed by B of A or whoever, um, are they just turning around and lending out our shares and then not telling us, and then using those shares to short the stock that we own? Right? We don't know because, again, they're not supposed to, but they've been caught doing this many, many times. And again, I would point you to the House of Cards DD by Adabit. He lists out like a lot of the infractions that these companies have done. And then I think there's another one he has that specifically goes into this problem. But yeah, so with that concern, people started postulating that DRS was a way to remove the shares from the brokers or from the intermediary, right? If it's Fidelity or if it's B of A or Merrill, and take them back into your own custody. So transfer them to a transfer agent, have it registered in your name, and not be able to be lent out. And so that's what we've been, what the push has been for the last, 3 years now. And at one point they had DRS
Yeah,
25% of the float, which was
I
significant.
saw.
And from what I've seen, a lot of the liquidity indicators on GME have fallen quite a bit, like trading volume, everything. So it has had an impact. Now the question is, can we get to 100%? That remains to be seen, right? Is there enough buying power and staying power to get all the way to 100%? We don't know. And even then, if we do, like, what will happen? We don't know because no one's ever DRS'd 100% of a float, as far as I know.
Right.
So
Well, there's
yeah.
also yeah, because I was trying to follow that metric too out of curiosity, but what do you think of the role of the at the markets? Because it didn't look like it didn't look like those drops were like being heavily bought, but I can't tell. Like I don't know like what the retail slash broader ape sentiment is right now, specifically with respect to not whether or not it's good or bad. Don't care about that, but more so like accumulating those shares. Is that still the idea, or is it after those at the markets, it's kind of like difficult to get back to where they were?
I think it's the community is all over the place, honestly. Some people are,
Got it.
from what I've seen, some people are just holding what they have and they're just like, I'm waiting for the squeeze. And Ryan Cohen's built up $4.6 billion. I'm excited to see what he's going to do. Other
Yeah,
people, which are understandably, other people are mad about dilution and they don't want it to happen. And they say, look, even though you diluted obviously at high prices and profited from this, we still don't like it. We don't want you to dilute at all. And then there's a third group that's like doesn't give a fuck and they're just buying every 2 weeks and DRSing with their paycheck. So
I see.
I think
And
people are all over the place.
yeah, interesting. Willie has a question for you. Willie says, your take on price stabilizing at the 20 handle after two at the markets.
I mean, I think it's indicative of probably where the new floor is for the stock. So with $4.6 billion of cash, the hard floor, which is cash per, like their cash on hand per share is like I think $10.74 now. So that's like a very hard floor where literally they could buy back, they themselves could buy back all their shares with the cash they have on hand at that level. Um, but obviously the delta between that, the cash level, the cash value of all the shares and the current market price is probably where the enterprise value of the company comes in. So, those two combined probably are putting this $20 hard cap um on the price. And like we said earlier, right? Like to say that that market makers have infinite power is incorrect. And again, I'm
Right.
just saying that this idea of infinite liquidity is or maximizing
Sure.
liquidity is faulty. But it's absolutely true that they don't have infinite power. I mean, or else no stock that they ever wanted to not rise would never rise, right? So if they had that much power, so they clearly do have to follow market structure, market demands. If there's excess of buyers, they have to sell. It's just that they have a lot of wiggle room that they can move in, and they have a lot of things they can do. But this could also be indicative of market makers reaching the end of the rope and being able to, if they are complicit in driving the price down continually, or if other entities are doing it, they could be running down on their ability to do it. right? Because again, fundamental factors do matter. Ryan Cohen buying 12% of the float in August 2020 and then changing the board and reimagining the business plan caused the stock price to rocket from $5 to 400. So yeah, clearly there's fundamental factors here that can affect price. So this can be one of them. I think $20 will
Yeah.
probably be the hard floor for it for a while.
Interesting. Yeah. Because one of the things I took pretty strong note of is when the at the markets were going, we didn't like collapse down. Right. So that I think is very essentially confirmatory of your point, where it seems like we start finding wherever the current price is. Because what was the latest? I forgot. Somebody from the chat will probably know like what the latest cash value was. I don't remember.
Cash value is 4.6 billion.
No,
What do you
but
mean?
per share.
I said I think it's around 1074 was I
Okay,
think the
got it. Sorry, I
figure I
missed it.
saw.
Yeah,
I
got it,
think
got
ten
it, got
dollars
it.
and 74 cents. Yeah.
Okay, got it. Yeah, because the cool part there, I think, is it starts to also show how people are starting to value the intellectual property, the branding of the business. So, because if the floor does start coming in around there, that's pretty powerful.
Mhm.
Cool. I will ask one or two more, and then I'll get you out of here. I don't want to keep you on forever, but obviously, absolute blast chatting with you, man. It's really helpful for me from a learning perspective to pick up just more and more of the story. Plus, I'm just fascinated by it. So really appreciate it.
For sure.
Um, so our friend Vladimir off Putin, not to be confused with Vladimir on Putin, if Vladimir might have been on Putin. I don't know. Maybe I don't think Vladimir the vampire was gay. He might have been, and that would put him on Putin. I'm not sure. But share price was $10 in April. Ryan Cohen's basis is 261 on almost 37 million shares. Coincidence? Don't forget about BBBY. I don't know the share price was 10 and
Okay.
sorry, go ahead.
Why is that a coincidence? I don't understand the connection between his average share price and the stock price.
Yeah, same. So off Putin, if you have a follow on to that, let me know. I'd love to get further. Oh, he's saying he has an escape hatch. Oh, in terms of, I see. He's just saying essentially that he's on a good basis. That makes sense.
Yeah. He is on
yeah.
a good basis for sure.
So Captain Chris says, do you think swaps expiry is heavily correlated to spikes?
It can be. Again, here's the issue with the swaps. And this is what if you go back on my YouTube channel, so search Peruvian Bull,
Yep.
I did a long form video, like a 30-minute video on the swaps. And I explained this in that video. Like, look, we have some debt on the swaps. The issue is, and some of them were like huge rollovers, right? We're talking, hundreds of millions of dollars, billions of dollars for some of them in total. But the issue is that's the size of the notional size of the swap. How much of that is hedged and how much of it is unhedged? You don't know, right? Whoever the counterparty is. So, like, let's say this swap was Archegos and Credit Suisse, and then Credit Suisse now passed it off to UBS. So UBS, if they have a swap open for 5 million shares of GME, if they already have 3 million shares somewhere, then a lot of their exposure is hedged and they don't have to worry about the rest of it. Or if they're able to hedge it through options or another swap, what if they open up a swap with another counterparty that hedges, passes this hot potato? So this is the issue with this, what we talked about earlier, the opacity of the market is you don't know, the exact details of the swap. We don't know how much is hedged. We don't know exactly who the counterparties are. Even in the data sheet that I linked in that YouTube video. I think I linked it, but I discuss it. You obviously don't see the counterparties. It doesn't say, counterparty 1, Nomura, counterparty 2, Archegos. Doesn't say that. It just says, here's the swap. Like, this 200 million, basket swap entered at this time, edited at this time, and here's like 5 tickers. Sometimes they say, here are 5 tickers that were in the basket. And sometimes they don't even say that. So you don't even know. So that's the issue. Like I would say, look, you can try to trade off the swap data, but it's not a guarantee. Because if it was, I'd be a much richer man than I am right now. And I'd be living in a mansion. But
For sure.
I've seen massive swap rollover dates, and I'm sure you have too. I've seen massive
Yes,
ones happen and the stock price not really move. Like maybe it jumps
exactly.
3 or 4%.
I think,
Yeah.
yeah, exactly. Because I ran, there was somebody in my community that was piecing together the swaps, and they grabbed like a whole list of them. And this is also what I was working on with Newton with. And I looked at a correlation between all of them. The problem is when we look at a lot of the relationships, we tend to focus on the ones that align with what we're trying to see. So, for example, if we want to see or think there is a relationship between swap expiration and then stock price movement, our mind naturally clings on those instances. But when we look across like the broad breadth, just completely looking at all of the swap expirations and the follow week price performance, it's not super indicative. Now, the follow-on question I would have for you there, though, that I'm really interested in, because I haven't found a good source for me to test, and I'm trying to find something, is in terms of correlated correlation. So, is there any other factor that you're aware of with if big swap comes up and other factor, we think there's a strong relationship with price movement? Because I've tried it with FTDs and it was inconclusive in terms of like the relationship. And I'm wondering if there's anything else that I don't know of that I could test.
Have you looked at ETF FTDs
Yeah.
specifically? Okay, because I was gonna say that's the one that I found was the strongest
It's
ETF
same.
FTDs. But the problem
Yeah.
is obviously with the lag reporting and data, like
Exactly.
it's a backwards looking thing.
Right.
Again, if I was able to find to accurately predict GME, which I would argue is probably the hardest stock to predict in the world, um, if I was able to accurately predict it, I would be a multi-millionaire because I would be
Yeah.
killing it. And I would probably be able to find the same thing true for every other stock. So unfortunately, no. I would say, the best. What I've found is GME trades really strangely around major events. So
Mm-hmm.
usually before earnings, the stock price will grind lower for a few weeks, and then it will pop up until earnings, and then it'll be slammed down after earnings and get be in the dumps for a few weeks. So do this is no guarantee, but like from the data I looked at, it was a pretty common occurrence for the stock price to fall. So if you want to go long before, sell right before earnings, buy in a week later after earnings, after the stock price is tanked, that could be one strategy. But again, it's no guarantee because there's also been earnings where not much has happened. So we just don't know.
Yeah, for earnings, I have a data set actually that I can talk about it super fast. That'll look through the last. If you use Thinkorswim, you can actually look at. I think they show you the last 8 and the price performance leading into and then post earnings. But there's another data set that I have that goes back a lot further. But the one of the main things I think for GameStop specifically that I can accurately point to literally every single time before it has a big movement. And it's not always positively predictive of big movement, but I've seen it, and it's the only thing I've ever seen uniform across every single big move is a volume expansion before the big move. It typically starts a few days out that you can see it. And it's a multiple of preceding volume. It's not like double. It's typically triple plus.
Yeah.
So,
Yeah.
and there will be instances again for everybody. It's not like this magic cheat code because there will be instances that volume will triple plus and then price doesn't move. But it's one of the few things that I found a very strong correlation with with respect to price movement.
Have you talked to 6 days about a heat lamp theory?
I don't know who that is.
Okay. This is another interesting rabbit hole you could start pulling down. 6 days, 1 week. He wrote a really great DD called Heat Lamp back in 2022. And he's expanded on the theory and added to it quite a bit. But another thing is he noticed around DRS record dates, massive jumps in volume. Like we're talking the average volume traded going from 5 million to 60 or 70 million in a day, and then falling back down to 5 million a few days later.
Interesting.
Right around a DRS record date, which is like indicative of something going on with and not all of these obviously were coincident with price increases. Like the price might have stayed the same, but someone was furiously trading GME shares in the background to cause 60 million share volume in a day. Um, and and then the price just doesn't move. And then DRS record date passes and somehow DRS numbers don't move. So there's a lot of weird shit going on with this stock. Let's just say that.
Yeah, dude. I'll have to take a look at that. If um I'll shoot you a message or something and see if you can
Yeah.
send me a link to it, because I'd love to read through it. Cool. Well, I guess the last thing I'll hit you with before we wrap then is just looking at GameStop now. What do you think about it going forward? I know it's a big question, but I I get really engaged by all the different theories in terms of how GameStop might use the money, and I find a lot of that just very, very interesting. So super, super interested in your thoughts on that.
Sure. Yeah. No, so going back to that earlier tinfoil, right? There's a couple different theories of what they could be doing. They could be just going, they could be trying to reinvigorate all their and rehabilitate all their stores, and or they could be trying to build out a totally new online platform. Although 4.6 billion, that doesn't point to just uh, an internal, optimization of their systems or whatever. It points to acquisition. So likely, I think they're going to acquire someone and acquire someone large. Now, question is who? And the BBBY people will tell you that Ryan Cohen's going to come in and buy BBBY out of bankruptcy. Other people will
Why
tell
did
you that
why do
what?
they think that?
Because Ryan, like I said earlier, Ryan Cohen's listed as a creditor um, on the BBBY cap table. There's also correspondence between him and I think some judge ruling on the case.
Okay,
Like there's yeah, I think you'd have to ask them. Again, I don't follow the BBBY crowd that
sure.
deeply because it's not just on the stock I trade. But um, there's some people who think it's that. And I think the more likely is that GameStop would want to acquire someone that's in a similar category to them and just expand, right? And just continue to follow down this path of revitalizing retail brick and mortar. So I think that's the likely option. But right now with 4.6 billion in cash and making 5% of that, they're sitting pretty. So they don't need, you know, they're fine. I mean, they're also profitable, right? And their store footprint's down by 22%, their SG&A expenses are down by like 29%. And they yeah, even though the revenue has fallen, overall they're a much healthier business than they were 3 years ago. So I think Ryan Cohen has done a good job of turning around the internal fundamentals of changing the functioning of the business to actually be effective and profitable. And he's been working on now what are the next steps to do with his cash, and whatever you do with it, you have to make sure like all the I's have to be dotted and the T's have to be crossed, because you don't want to mess up an acquisition like this. This might be your one shot at a valid acquisition that can help rocket you out of this, kind of quagmire that he's in.
Yeah,
Not to say that it's like he's not in a position where things are going downhill, but it's like now, okay, he stopped the bleeding. GameStop's no longer losing money. They've eliminated a lot of their stores. They've cleaned up, their act. They've eliminated a lot of the old board, for example. Now the question is, how do they really turn this into a revolutionary company, which is, potentially could compete with Amazon. So we'll have to wait and see what he does. I don't have a solid answer for you on what I think
of
exactly he's
course.
going to do. Yeah.
Yeah. Last clarifying question on that though. Do you have any thoughts on kind of a timeline that you would expect to see movement?
I would say, I mean, just personally within, 6 to 9 months. I mean, usually if you get this level of cash, you wouldn't sit on it for more than a year. That's what I would assume,
Ex- Literally
you know.
exactly my thought from a general perspective, but I didn't know if there was any specific nuances with GameStop, because
Uh,
I find it interesting. A lot of people are like, oh, like they're making, interest on their money. And like it's good to make interest, but it's you don't raise that money to make interest. You raise it to do something.
yeah, exactly. So no, they're gonna have to, yeah. They have to figure out what they're doing. Or they probably already know, but they're just not telegraphing it. Obviously, they don't want to. It's a bad business practice. But yeah, I think in within the next 6 to 9 months, we should get a clear answer on what they're actually going to do with all this cash, because sitting on this for forever doesn't really make sense. I have seen other companies raise money and hold it for 6 months or a year, but I've never heard of a company raising this level of money and holding it for like 2, 3, 4 years and just never doing anything with it.
Yeah,
So
yeah.
yeah, we'll have to wait and
Fascinating.
see.
We will. Dude, super, super interesting. Thank you so much for coming to hang out for a little bit, sharing what you know. Before we wrap, obviously you're on YouTube at Peruvian Bull. People can find you on Twitter. It's the same handle.
Yes, yeah, Peruvian_bull, and look for the one with the verified trademark or the verified blue check mark, because I have a lot of clones that will try to. They might try to get you to join some Telegram group or some Discord. Like I don't have any of that. All I have is the
Well,
I have a website, a Substack, a YouTube, and then my Twitter. So
beautiful. Yeah, and I'll grab the links to you and then I'll throw them in the video notes so that people can find it pretty easily. But dude, thanks for hanging out. We'll definitely have to do it again. It'd be fun to take a look. I'm in the process of finishing going through all of Roaring Kitty's old trades. I think we're on like part 5 of the series. So his Reddit profile, we went down to the bottom and I essentially tracking the differences between the trades and the way that he's trading them, which has been fascinating. So once I get that under my belt and I have a slightly better understanding of him, I'd actually love to tap into your understanding of him just as an actor, because he reminds me of like the Joker from Batman. You like really don't know what the dude's gonna fucking do, and it's hilarious.
yeah, that's why this whole thing has been like I said, it's something that's like a meme. It's like a glitch in the
Yeah,
matrix. It breaks again. It breaks all the traditional financial dogma, right? You should sell your winners when you're up. When you make
right.
$40 million in a week, like Roaring Kitty made in the first week of 2021, you should sell. And then he's just like, no, I'm not
Or
selling. I
set a
don't care.
stop or
Yeah.
anything. Yeah,
No,
dude.
no. He just is like, what's an exit strategy? And then he comes back in May of 2024, three and a
Yep.
half years later, and somehow he has fucking like $200 million. It's like,
Yep.
where did he come up with all this money? Like, what has he been doing? And no answer. He's just like, oh, by the way, I bought 5% of the float of GME in options expiring for next month. Like, let's go. Yeah.
Dude, absolutely classic. Yeah, it's been understanding his movements has been really, really interesting. Because at first I thought maybe the value investor, normal to have like price targets. Clearly not that. Then the way that he even manages his options trades, I found that to be really interesting. That he sometimes would sell his in the money options and hold the out of the money options, which I also find that super interesting. It's like a series of just questions. I'm just like, I don't fucking know what's happening. It's epic.
Yeah, it is epic. It's probably the best, story in finance in the last 2 decades, at least, if not more.
Couldn't agree more. Yeah,
Yeah.
definitely the most interesting. So thanks for sharing your information with me, man. And we'll definitely reach back out and look to chat with you again.
Yeah, for sure. Let's do this again. This was really fun. Thanks for having me.
Yeah. Awesome. See you, everybody.